LaSalle, JLL Capital Markets, and I am this year's forum chair. I started JLL as a founding partner of Revista, and I had known Hilda, Martin, Mike Hargrave, Elisa Friedman from their days at NIC, the National Investment Center, where they had established a senior housing database, which is really the role model for the work that they're doing here at Revista. They had mysteriously disappeared from NIC, and they emerged right in my strike zone in medical office, and after a very momentary description of what they're doing, I said, sign me up, because their work in the past had been impeccable. And what I want to just tell you extremely briefly is they're committed to providing valuable information, transparency in the industry, and the work that they did at the NIC was demonstration of this information on properties, the qualities of the properties, was extremely valuable to build the investment case for the sector, create more transparency across the segment, and to help everyone in the industry to access capital and provide resources for them. So they've come a long way in the 3 years since they started, and it continues to be an incredible work in progress with more and more data and tools at your disposal. So it was very easy for JLL to sign on as one of the founding partners. So very proud of the growth in the database and what they've created. And we have demonstration in the room today, this conference, new record. We have 200 attendees. It keeps growing each year and establishing a great following. Want to welcome you. We have some great speakers today. One I'll introduce momentarily. Governor Tommy Thompson is going to do our keynote tomorrow. And we have a lot of great panels throughout the sessions tomorrow. This is an information conference, but it's also a networking conference, so hope that you'll take advantage of the opportunities, the reception this evening, breaks throughout the day, and take advantage of that. With that, I want to welcome our keynote speaker for the afternoon. He is Dr. Glenn Miller. He's a professor at the Burns School of Real Estate and Construction Management at Denver University. He's also a visiting professor at Harvard, and he is a real estate investment strategist at Dividend Capital Group. So he's well established and well known in the real estate world, and he is going to give us his real estate economic update today. Thank you.
Well, thank you, and very happy to be here. My job today is to kind of give you the big picture on what's happening in income-producing real estate. I use the term income-producing instead of commercial because apartments is one of the income-producing property types that major investors look at. And as I do this, I'm going to also, therefore, fold in the information from Revista that they have, even though the history is a little bit short. It'll be interesting to see what's happening there. I've done this before. I actually worked with NIC many years ago, and that's how I met the people from Revista, because I did some of the original research for NIC back in the early 1990s. So for me, income-producing real estate, there are three major things that every real estate investor should be watching looking at demand for real estate. And they are GDP growth. Obviously, when GDP is positive, the economy is growing, there's going to be more demand for space. Employment growth is literally number one in almost all the property types. And so every time someone's employed, they need a place to work, right? And as you can see here, you can see that in 2009, we had the Great Recession. Since that time, we're growing employment at about 2%, and GDP growth is running in the kind of 2 to 3% range. The last quarterly information that just came out was 1.4%. But actually, I think number one for medical office is actually population growth. And I think you probably realize that the United States is growing slightly less than 1% every year. And we're 340 million people now, so we're growing by 3 million people a year. And if I can put that into real estate terms for you, that means we need to build a complete city the size of Denver, Colorado, metro area the size of Denver, Colorado, every single year to give those people a place to eat, sleep, shop, work, play, and go see a doctor, okay? And one of the interesting things is population probably hits medical office even better in the fact that if we start looking at the demographics, we've got my generation, the baby boom generation, coming into retirement. As I'm sure you all know, we spend the most money on our health care as we get older. So the demand curve is very, very strong from that standpoint. On the cost side, two key things that we look at are inflation, because obviously operating properties and building properties cost more over time. And we are in a low inflation environment, if you will, and have been for a long time, averaging about 2% over the last 15 years. If you'd gone back a couple of decades, it used to be 4.5% was the long-term average for inflation. So we've been in a low inflation period for a long time. And the other one is interest rates, and the two key interest rates are 10-year treasuries, because we can't go out and get a 30-year mortgage. We're only going to get a maximum 10-year, right? And 10-year treasuries are at an all-time low today, sub 2%. I think they closed about 1.6 here yesterday. And then short-term borrowing for construction is normally pegged off of LIBOR. LIBOR is running about 3-month LIBOR is running about 0.5% today. So we've got low cost from both a operation standpoint and a financing standpoint. All of that is really good for real estate. And if we look back over time, you can see the different recessions here. Both GDP and employment growth fall together. That is our kind of definition of a recession. You can see that some expansion periods are longer than others, and I believe that the one that we're in right now probably is going to last a fairly long time, okay? Longer than most economists predict. A lot of economists are saying, you can't go for more, there has to be a recession at least every 10 years. Well, I'm not sure that's going to happen because we aren't having the kind of boom-bust cycles that we've had in the past, okay? Here's great proof for you. Population, or here's total employment for the United States, the black line, and then occupied space for office, industrial, and retail, and you can see that they follow each other pretty well, right? They're highly correlated. When employment growth slows down, occupied space slows down a little bit, but when it picks back up, we see all of those pick up, okay? So, I was a professor here in Denver back in the late 80s and then got hired away by Prudential Real Estate Investors in 1990. Just as the whole real estate market was crashing, they asked me to look at what happened, why it happened, and figure out what was going on. And so I started studying real estate cycles. And what I came to was that there's really two different types of cycles in real estate. One is the physical cycle, and the other one is the financial cycle. The physical cycle drives income, the financial cycle drives prices, and we'll see how that works. So the three key metrics that we have to watch are occupancy rates, rental rates, and then property prices, okay? So the physical cycle is basically look at the demand and the supply for space. That's going to drive occupancy. And the higher the occupancy, the higher the rent growth is going to be. And add those two together. If I have an increase in occupancies and an increase in rents, I just increase the income on my property, right? Very simple, basic, straightforward stuff. So here's my cycle graph, and if you will, it's nothing more than a vacancy graph upside down. And you'll see why I use occupancy instead of vacancy as we go along. 4 parts to a cycle: a recovery and expansion, a hyper supply and recession, and obviously declining vacancy on the way up, increasing vacancy on the way down. The other key metric to look at is in a recovery, we don't build much new because rents are low. We can't justify that. We obviously get new construction in both the expansion and the hypersupply phase, and in the recession phase, we typically don't get a lot of construction, but we've started buildings that are now being completed and adding to the supply when we really don't need it, okay? So what should happen? Well, I did a study back in the late 90s looking at it, and what I found was historically real estate cycles were about 15 years long. So I had a timeline here with 16 points on my graph, and you'll notice that there are 11 points on the up cycle and only 5 on the down cycle, okay? So when we're in recovery, When you're at the bottom, you've got too much of anything, what do? You drop the price, hence negative rent growth. As you come through the recovery points 4, 5, and 6, we're starting to get some rent growth, but at rates that are below inflation, okay? Across the long-term average, and I'll use office as my example here today, the long-term average office occupancy level for the United States historically has been 87.5%, or a 12.5% vacancy rate. That's been the long-term average. So that would be 0.6 and 0.14 on my graph here, all right? Above that, market's tightening up, rents are rising rapidly towards 0.8. That's a key point on there, and it's in green because it's cost feasible rent levels. And what do I mean by that? Well, if it costs $300 a square foot to build a new office building, and investors who are taking the risk of developing new property want a 10% rate of return, 10% of 300 is $30 a square foot. So if rents aren't at $30 a square foot, it doesn't make sense. It doesn't justify building the new building. So that's a key point to watch as we look at different markets. Above that, we can't obviously turn on the widget machine, put up a lot of space really quickly. So demand's growing, supply starts to kick in and catches up when supply and demand are growing at the exact same rate. Remember your old Econ 101 class? That's known as equilibrium, okay? So if demand and supply grow together at the same rate, we're in great shape and things go along well. But one of two things typically happens. We get greedy and we start building too much, so now supply is growing faster than demand, hence hypersupply. Or we go into a recession and demand drops off while supply is still at a fairly low rate, and again, supply is above demand. That creates the hypersupply phase and the recession phase, okay? So if I then look back, I did a study where I looked at this over 30 years, and the numbers work out pretty good. Looking at the 50 major office markets in the country, at the bottom, position 1, 2, I've got negative rent growth. At 3, 4, and 5, I've got low rent growth and below inflation. At position 6, I got a 4% average rent growth, and over that time frame, 1968 to 1997, the average rate of inflation for that 30 years was 4.3%, okay? Double what it is today. Then you see it start to go up, 6, 7, 10. At position 10, 12.5% rent growth in an individual year, okay? Then at the peak, it starts to slow down, 11, 10, 6, back to below inflation at 14, and then low and negative again at the bottom. So if you knew where your market was, would that not help you in making leasing decisions, in making purchase decisions, in making decisions on when to expend money, fixing up the lobby to try and bring in new tenants, et cetera, okay? So every quarter I put out my market cycle report, and I look at the major property types and where they are in their marketplace. And where do you think the economy, here's our cycle today, where do you think the economy is? What number would you put the U.S. economy at today? Remembering that, for me, employment growth is what's driving demand. I'm sorry? In hypersupply? Okay, in other words, we have more employees than we need, and we're about to see employment drop off? No. We were at the bottom back in the Great Recession in 2009, the beginning of 2010, right? We lost, 4 million jobs. We recovered all of those jobs in 2014, which would put us at position 6. Today, we're probably at, depending upon which economists you talk to, we're probably at position 8 or 9. We're in the middle of an economic growth phase. And I have to use economists' forecasts in the work that I do, and most economists are saying, it looks like, we've got the millennial generation coming of age, getting jobs. We've got somewhere in the neighborhood of 4 years or so of employment growth coming along, assuming no big black swan event or whatever the case may be, okay? So the economy is at 0.8 or 9. Where is office? Well, suburban office is at 0.4, downtown office is at 0.6. It's lagging the economy. Why? If we've got this demand, that means we're either putting up a lot of new office, which that's not the case, right? But we've got all this new employment, and something has changed in the office world, and that is the long-term average space use for just general office space used to be 200 square feet per person, okay? Now, with internet and job sharing, and you've probably heard the term benching, You're not going to get an office. You're not even going to get a cubicle. You're just going to get a bench space because you're going to be working on a team in a little conference room, et cetera, et cetera. We're now at new space being developed and used is at like 110 square feet per person. So we need almost twice as many people being employed to get the same demand for the same amount of space. Now, medical office, because of the demographics we talked about, et cetera, it's literally at 0.8 in the cycle. The one thing they have to understand is that, remember that medical office, that regular office space potentially can be a substitute for medical office, right? A doctor can't find something, they can still go out and rent some regular office. So that's gonna affect how much rent growth you might be able to get, right? Doctors aren't gonna come to you and say, hey, you know, you're asking for $40 a square foot, I can go right across the street and get regular office space for 30 and just configure it for myself. So, you know, you're kind of you're a subcategory to a major property type, if you will, that's going to drive some of the things that go on. We look at retail, it's kind of at the growth phase. Hotel is near the peak. Full service hotel is the top. The only property type that's over the top is apartments, and that's not because we've got a decline in demand. We've got really good demand from millennials, but we are overbuilding the marketplace, and I'll give you Denver as an example here in a second, okay? So what I do is I look at now the 54 largest markets in the country and where they are in the cycle. National average is at position 6, okay? You can see the best markets in the country: Austin, Texas, San Francisco, and San Jose. And I just highlighted Denver so we can see the differences in property types as we go along here. Denver is right where the national average is at position 6. Worst office markets in the country: Houston. Why? Oil industry dropped off. The demand for space, you know, demand dropped off there, et cetera. Okay, we look at industrial. We can see that the national average is at 0.10. Why is it better than the economy? Internet sales, more stuff. We've got more SKUs, right? When I was a kid, there were, my two choices were Coke and Pepsi. Now there's Coke Diet Coke, Cherry Coke, Vanilla Coke, Coke Zero, on and on and on. Grocery stores, instead of 40,000 barcode SKUs, now they've got 120,000 in the same, you know, in their stores. So we need more space to store that stuff. Denver is a little over the top. Why do you think that might be? We had this huge demand boom because of legalizing marijuana, right? And we started building for it, and we have, in essence, now started to overbuild for that because they assumed that demand would never end, and we've got a little bit too much space going up, okay? Look at apartments, and again, because we're putting up too much, the national average is over the top. Denver is even further along, and the example here is we need about 8,000 new apartments in the Denver metro area every year, and have for the past 3 years. 3 years ago, we built 8,000 apartment units, matched up very nicely. So we were right at equilibrium at 0.11. Last year, we built 10,000 units for that 8,000 of demand. This year, we've got 12,000 under construction to be completed in 2016. Hence, we're over the top. And what do you think landlords are doing? Offering some free rent. They're trying not to drop prices, but they're offering free rent or concessions or whatever to try and hold their prices up. Okay? And then retail. Retail is, if you will, another alternative space use where medical office, as you probably all know, you have some medical office that goes into retail centers, and there's probably some interesting plays there, as well as interesting conversions. I'll give you an example. I grew up in Oshkosh, Wisconsin, and the first mall that we had was actually built right near downtown, not out in the suburbs. And when it went under, because it wasn't large enough to expand to have enough anchors, it was turned into office space. And the city of Oshkosh took over and put all their offices in it so that you had a nice place to walk around indoors and parking in the whole 9 yards. And then the rest backfilled with service type office space, and I believe there's a dentist in there, and restaurants and everything else. So it's still used as a community area. So national average at 0.9, right where the nation is, and Denver actually doing a little bit better. People in Denver actually spend more of their disposable income, I think because we're into such sports and things like that. Snow skis can be expensive, as you probably know. Two things you should know about this about the chart. First of all, as you look at it, you can see that there are some cities that are in bold and italics. Okay, those are the institutional quality markets, or if you will, of these 54 markets. In the case of office space, it takes 11 markets to make up 50% of all the square footage in all 54 markets. Okay, in retail it takes 12. In apartment, it takes 14, but in other words, there are some really large cities, right? And then all the rest. And the other one is you see numbers after these, and when I first started producing this, clients would say, hey, how do I figure out where things have moved from and to? I have to go back and look at your previous quarter to figure out what's moved. So we started putting in the numbers and saying that, for instance, the nation has got a +1. So last quarter, it was at position 8, and its occupancy has improved enough to move up to position 9. Okay? And then finally, hotel. You can see that the national average is at the peak. We are at the highest average occupancy in this country for hotels that we've ever seen since they started collecting data. Denver is there as well, part of that being the pot effect, because it's become, if you will, marijuana tourism has become very large here as well. Okay, so that's where we are. But what you really care about is where are we going and what's going to drive what's going to happen in the future. Well, to do that, we need to kind of look for macro trends that might be affecting what's going on. So I'm going to go back through my, I hate to say it, but 40 years of experience in the real estate industry. My first job was actually at United Bank of Denver, at downtown Denver, at the corner of Broadway and 16th Street, which is now the mall. And I started out analyzing construction and development loans for them. What was driving office space? Well, you had really strong demand from the 60s. That stopped with the recession in 1974. Capital was coming in from mortgage REITs, and we were oversupplying the marketplace. We didn't actually have good data. No one knew what average vacancy rates were or anything else in the marketplace. In the second half, baby boom generation, that would be me going to work, creating a ton of demand for space. The capital that had been flowing in the first half shut down, so there wasn't a lot of new supply. Lenders recovered, and the market picked up. And in 1979, we reached a peak occupancy of 95%, or a 5% vacancy rate. So let's look at the demand and supply numbers. Here you can see that demand, the yellowish bar there, grew at an average of about 2% in the first half of the decade, whereas supply grew at 5%. More supply than demand, we're going through a down cycle. Then in the second half, demand grew at an average rate of around 4%, whereas supply was growing at about 3%. We're into an upcycle. 1980s comes along, the tight markets pushed up rents and prices, but we had really high inflation. Anybody remember what inflation was in 1980? It averaged around 15%, okay? And so we also had an extremely high income tax rate. The top federal income tax rate was 70%. So we went into a recession. Congress was trying to figure out what to do. They passed the Tax Act of '81 that said, if you make an investment to help stimulate the economy in something like a new real estate building, you can take the depreciation off that building against your tax rate. So we were doing things for tax purposes, not for economic purposes. We also had thrift regulation. It used to be just commercial banks could make loans on income producing real estate. Now savings and loans and thrift banks that only made them on homes were doing it as well. Second half, Congress may be slow, but they're not totally stupid. In '86, they cut the income tax rate in half, got rid of all the tax shelters. Great thing for real estate, because now you had to be economically driven to make that happen. So that slowed down taxable investors, but not the tax-free investors. Who are tax-free investors? Well, those would be what we call the institutional investors, the pension funds and the endowments of this world. Anybody know the largest public pension plan in the United States? CalPERS, California Public Employees Retirement System. It is a $330 billion pension plan. That's the assets they have that they invest. And when I came to Prudential in 1990, we were out trying to convince them that real estate wasn't just a little sideline thing, it was a separate asset class. CalPERS has a 12% allocation to real estate out of their portfolio, so they got about $36 billion invested in real estate. So Between the years of 1975 and 1985, that 10-year period, the average rate of return on the stock market, which historically had been 10%, was 0. So all these pension plans were underfunded, and they had to go back and ask the state for more money. Or United Airlines, Ford Motor Company, et cetera, had these defined benefit pension plans as well. So they were looking around for where can I get a better return, and real estate between 1975 and 1985, based on the MREIF index, had earned 15%. So they started piling in and buying real estate as well. So we had rising real estate prices that were masking the poor income returns. In the 1980s, we constructed a ton of office space. It grew at an average rate of 7.7% per year. And if you remember what compounding is, right? If we compound those growth rates over that 10-year period, we more than doubled the amount of office space in this country in 1 decade. Other fun factoid, 80% of that new construction was in suburban office space. We created suburban office in the 1980s. But the most amazing thing about this graphic here, or the statistics, are that demand grew at 3.8%. And you're going, Glenn, wait a minute. What do you mean? Why is that so fantastic? Well, population's growing at 1%. Employment was growing at 1.4% because the baby boom generation, people like me, were getting our first jobs. So how is it possible that demand for office is going at 3.8%? Answer, in 1960, 25% of all employment in this country was in manufacturing. Today, it is 8%. In 1960, 8% of all employment was in office-using jobs. Today, it's 30%. We're going through a changeover in our economic base. This country used to be based on manufacturing. Now it's based on information and technology, et cetera. So space use has changed in a radical way. So 1990s comes along, moderate but stable demand growth, even with a recession in 91. All that oversupply from the 80s had foreclosures, and we shut down new construction and absorbed that space. Second half, the demand continued, the oversupply got absorbed, and return performance continued. Construction became constrained. It became harder to build. As many of you that are developers know, it's a lot harder to build today than it was a couple of decades ago. And we end up with more efficient markets where supply and demand matches up because we have more information. So if we look at the 90s, now you can see that in every single year, demand grew at a faster rate than supply. In essence, we had no supply at all, less than 0.5% between 92 and 95. And then finally, we hit some nice equilibrium in 1998 and 1999 where demand and supply matched up, okay? Next decade, 2000s, globalization. U.S. economy became more stable but slower. Technology versus a manufacturing economy. Market data became available. Every major Jones Lang LaSalle, Torta Wheaton research, we've got all these different CoStar, all these different companies that now produce research for researchers and companies to use in analyzing things. Millennial generation started entering the workforce. We ended up getting into the public capital markets. Real estate got its first real access into the public capital markets. As a matter of fact, one of the things I like saying is when I started in the 70s, real estate was a local business. Local buyer, local seller, local bank doing the financing. In the 1980s, the institutions came in. National buyers, national sellers, national financing going on. In the 1990s, we got equity capital from REITs coming public, and we got debt capital from CMBS, okay? And now, since 2000, we've gone global. All of a sudden, you've got a property up for sale in a major market, and there's probably going to be 5 international bidders bidding on that. Plus, you may be getting your financing from Deutsche Bank or another international company. So that helped make our capital markets more efficient because there was more information available. And we had supply constraints as well. Steel and concrete, which is what commercial buildings are built out of, much harder to get, rising at a faster rate than inflation. Infrastructure costs and other things also making it more expensive to build. So if we look at these years, we see that in 2000, we ended up oversupplying by a little bit, and then first time ever, negative demand growth from the technology bubble bursting. That comes back, and you can see the lag in Demand drops down in 2000, 2001. Supply, it takes a few years before it slows down. Demand picks back up, and it takes a few years before supply picks back up. 2009, another negative year with the Great Recession, but then a starting rebound right after that. So now, next decade, 2010. Slow economic growth, I think 2% is about the GDP norm going forward. A longer economic cycle, low interest rate environment, 2% 10-year treasuries, I think that's going to be around for a pretty long time. A millennial generation workforce, very different from their parents. Millennial generation consumer, very different as well. Technology making changes. Baby boomers retiring, obviously big thing I think for medical office. Sustainability is the new key. Everything you do has to be sustainable. But it's really still employment growth that's driving demand for commercial. So if we look at supply over time in the 5 major property types, you can see we hit an all-time low in new supply in 2013, and it's recovering very slowly. As a matter of fact, office was the slowest recovery in new supply this time around. And if we look at what's happening, we can see good, strong demand over the past 5 years, and it looks like that demand stays strong. It slows slightly from about 1.1% down to 0.8%, supposedly by 2020. And remember, I have to use economists' forecast. I think we could go along at kind of a 1% rate, but I'm not an economist. I have to use an outside independent source in my data here. And they all keep saying there's got to be a recession coming up. There's got to be a recession coming up. I'm not sure that's going to happen. Supply, of course, is kicking back in a little bit. So if we go in and look at the forecast, here you see demand and supply, and now you know why I use occupancy instead of vacancy. Do you think rent growth and occupancy level are highly correlated? Sure looks like it. As a matter of fact, the correlation between occupancy level and rent growth is 79%. And what I did was I went back and looked at cycles. In the recession in 91, rents dropped by 10%. Then in the growth phase, they increased by 49%. Then they dropped by 11. Then they increased by 17. Then they dropped by 9. Then they increased by 16.9 today. So rents overall, adding the negatives and positives together, are up 52% over the last 25 years. Okay? So here's the average occupancy going back to 1988 for office space. And the Revista data starts basically in 2009, and you can see that the correlation, that the average occupancy in medical office is 4% higher than normal office space. This is good news for you to use when you go in and talk to a lender and they go, wait a minute, where are you getting your occupancy number? And you go, well, the data shows that on average, medical office has a 4% higher occupancy level than just general office space. Okay? The correlation is there is low because you actually had some real strong occupancy increases during the Great Recession. You were, in essence, going in the opposite direction. You corrected a little bit, but then have taken off again, so you've only got a 20% correlation there. If we had a longer data series, I'm not sure where that would come out. Okay? But if we look at rents per square foot, we see that on average, from the Revista data, that you're getting $3.14 on average, U.S. average, better than other office space, okay? And there, the correlation in rent growth is 89%. So if you're expecting a market to have good rent growth, your medical office should be growing with it. Because obviously, if a doc comes in and says, I'd like this space, but gee, I could go next door and say, well, their rents are going up, so are mine. So that's a key thing to watch as you go along, okay? If we look at operating expense growth, it's rather interesting. The Revista data tells me that your expense growth has been basically flat to slightly negative since they started collecting the data in 2009 versus the consumer price index over this time, which, by the way, includes the Great Recession. And that the increase in inflation from the consumer price index has been a little less than 0.5% over this entire time frame as well. Okay? So that's all good news for you. Okay, so if we do a forecast, basically the numbers are going to look the same. National average at 0.6. If we look at, this is industrial space. Let's move on to retail, which is the important one for us here. Retail, you can see overall up We only have data from 1975, so 20 years up 31.5% there over time, and looks like it's going to continue to grow. The retail forecast is for the national average to be getting close to a peak in occupancy, which means you should be able to drive rent growth against, if they say, well, I can go get into the shopping center, and you go, well, their rents are going up as well. And things look strong there, okay? So that's the first part of the cycle analysis, okay? Demand and supply drive occupancies, and occupancies drive rent, and that gives us our income forecast, okay? Now let's talk about prices. What am I going to buy a building for, okay? And it's basically capital flows, people wanting to buy, money coming in, that's going to make a difference in your real estate prices. So here's the property cycle, the blue line, and the capital flow cycle is the black line, and basically it says when things are bad, not too many people are buying, so capital doesn't flow in. As things get better and people have good expectation, capital flow picks up. It reaches its highest rate of growth as it goes through that cost feasible rent level. It peaks out in the hypersupply phase and then drops off very quickly, okay? Because there's two types of capital flowing to real estate. One, the green shaded area, is capital flows to existing properties. So if you buy a property from me for a higher price than I paid, more capital just came in, right? The other one is building. And so starting at the cost feasible rent level, it actually probably starts a little bit before that, because developers say, well, I'm penciling out for a building that's going to open in 2 years, and the forecast for rents then will be X, right? That goes, and capital flows there go all the way to the bottom, because if I started a building right at the peak, I'm probably still finishing it here in the recession phase. So I go out and spend a lot of time with investors, and I say to them, you should have an allocation in your portfolio for real estate. Why? Basically because of size. If we looked at U.S. real estate, and this comes from a study by CoStar, okay, not houses, not home ownership, income producing real estate in the United States, $18 trillion versus equities at 26 trillion, bonds at 38 trillion. So it's about 22% of the investable universe. Go look at institutional investors. They've got anywhere from a 5 to a 20% allocation to real estate in what they're doing, okay? And there's a company called Real Capital Analytics, who, a good friend of mine, Bob White, who started collecting data back in 2000, looking at every single income producing real estate transaction in this country over $2.5 million, okay? And so you can see that transaction flow at about $20 billion back in the first quarter of 2001, peaking in 2007 at $160 billion, dropping to about 10 trillion in 2009, and today back at even higher than $160 billion in the fourth quarter of 2015, right? And then their price index, as a matter of fact, you've all probably heard of the Case-Shiller Home Price Index that watches the national average. Have you all heard of the Moody's Real CPPI, which stands for Real Capital Analytics Property Price Index? That's the Moody's Real CPPI Index, okay? Do capital flows affect prices? Certainly looks like it to me, okay? We can also break it down by property type, and here what we see is from the peak in late 2007, price recovery, CBD office is at 134% of its previous peak. Apartments 139, suburban office the lowest at 89%. So different property types move differently, okay? But basically we all look at and buy properties based on cap rate, right? And here's the historic information from a company called Real Estate Research Corporation, who's been doing their survey on this since 1989. You can see cap rates at about 8%. Then with the crash in the early 90s, cap rates going to 10 as prices dropped. Then the new REIT era started. All these REITs went public, got money, started buying properties. They drive prices up, and cap rates down back to 8.5% in 1998. Then the technology bubble starts, and nobody says, who wants an old economy investment like real estate when I can own a tech stock that'll go up 100% in 6 months? So all of a sudden, REIT prices drop, they're not adding money, no one's buying, prices drop, cap rates come up. As soon as the technology bubble bursts, everybody goes, give me a hard asset, give me real estate. It's the darling investment. Capital flows in, property prices go up till 2007. Recession starts, everybody says, whoa, income's not going up, so I'm not paying more. Capital flow slows down. prices drop, cap rates bounce. As soon as the recession completed, as soon as we had employment growth, which started in the second quarter of 2010, cap rates come right back down. So when you look at this, you go, wow, real estate on a historic basis looks really expensive, does it not? But every day, these investors have to decide, am I putting my money in the stock market, the bond market, the commodity market, or the other asset class, real estate? So when we compare it to other things, and I'll give you a fun little story here. So, a couple of years ago when I turned 60, my retirement money is with TIAA-CREF. Everybody heard of TIAA-CREF? They're the largest private pension plan in the country for teachers, and my income from, I was at Johns Hopkins, I've been at Denver University twice now, and Harvard, all that money goes into TIAA-CREF. I don't have to change retirement accounts, okay? So I get a call from this young guy and he goes, hey, Dr. Miller, you just turned 60, and we'd like to come in and talk you through what you're going to do as you're starting to head towards retirement. I go, I do this for a living, I don't think I need it, but okay. So we sit down and he goes, and we normally recommend that you move from 60% stocks and 40% bonds to 40% stocks and 60% bonds. And this guy is 2 years younger than my son. And I go, dude, because my son calls everybody dude. He says, dude. I got my computer, I pull up this chart and I go, dude, how does anybody in their right mind come up with that number? Because I'll bet you what you're doing is somebody back at the office is taking 30 years of history of interest rates, okay? And remember that any investment you ever make has two parts to return, income and capital appreciation or depreciation, correct? So if we look back over the last 30 years, back to 1980, 1981 was the peak in interest rates, the average yield on 10-year treasuries, by the way, every time I add data, it keeps going down because it's so low, is around 6%, okay? But the average total return on 10-year treasuries over this last 30 years here has been 8.7 because as interest rates go down, bond values go up and they appreciate, right? I said, but that's not where we are today. Where we are today is the same place we were when I was born in 1953, and the average total return between 1953 and 73 was 1.9% because as interest rates go up, bond values go down. So I'm going to lose principal if I buy a bond today. And between 53 and 81, the average return was only 3.9 versus 5.9 for yield. So I don't want to invest in something that's going to drop. I don't want that. He says, well, what are you going to do for income? I said, real estate. You said I need to go more income oriented? Put me 60% in the TIAA-CREF direct real estate fund. So I am allocated 60%, and guess what? I've been doing great, right? Because it follows the MREIF index. In the last 3 years, the MREIF index has been earning 10, 11, and 12%. What has the stock market done for you in the past couple of years? Not much, okay? So when we talk to people and say, you should be considering real estate, but I think real estate's expensive, you go, wait a minute. Buy a 10-year treasury, what do you get when you invest in real estate? Well, back in 2001, the risk for investing in real estate, you got an extra 350 to 375 basis points for taking the risk of investing in real estate over a 10-year treasury. In 2007, real estate did look expensive because you're only getting 100 basis points over the 10-year treasury. Today, you are getting somewhere between 350 and 550 in extra yield, income yield in real estate over 10-year treasuries. Real estate looks like an excellent buy. Real estate looks like the cheapest alternative out there. You should be buying real estate. And if you look at office, the gold line there, it's running at about 400 basis points over 10-year treasuries. And 10-year treasuries are 1.5, so that means office is 5.5 for the major Class A downtown in the big markets, right? So they also collect who are the composition of lenders here, and you can see office, insurance companies are the biggest, industrial the same thing, retail is CMBS, apartment is obviously the government agencies, Fannie, Freddie, and Ginnie, and hotels is, again, CMBS. If we look at CMBS issuance, it dropped to next to nothing during the Great Recession and has recovered well. And like I said, real estate's now gone global. Real Capital Analytics has been so successful that they now have gone and they're doing this in every country around the world. And this shows blue lines of U.S. money going overseas, and the other lines is money coming from overseas back to the United States. So it's now we're now a global marketplace. So my conclusions: cycles can be long or short. I think we are in a long cycle, and the long economic expansion I think means that we're going to be in a long real estate upcycle. Cycles are driven by demand and supply, and you've got to be watching both of those. Supply is growing modestly off its bottom of 2013. And so I think we're in the growth phase. I'm shooting for 2020 at this point. Right now, my cycle model, because of using economists saying things are going to slow a little bit, sees it peaking in 2018, late 2018 at this point. Okay? On the financial cycle, capital flows affect prices, and the volatile stock market and low bond rates make real estate look like a great investment alternative, hence the reason that we continue to see more capital flowing in. Debt financing, as you all know, has become harder in this cycle because it requires more cash down. Supposedly the government's trying to stimulate the economy by low interest rates, so banks are offering you a pretty low rate, right? So in general, the government's doing that, but then the regulators are going, wait a minute, but we don't want you to take more risk. So you used to get a 75% loan to value. Now they say to the banks, no more than 60% loan to value, or 50, right? So you end up having to have more cash and find that extra equity, okay? And we're still at very low new construction. So make sure that in everything you do as you talk to investors, that you are differentiating between residential home ownership, houses, townhomes, and condominiums, which is what I say to people when I say you should be investing in real estate. Oh, I already own a house. You go, no. That's a use asset. You live in it. You don't live on it, right? You live on your investments, and income producing real estate is an investment. Separate those two out. And the housing market obviously follows the economy as well, but if you want to invest in the housing market, the only way to do that is in home builders, because it's just like cars. It's a production process. They don't make a dime until they sell the house, right? Here, you are, if you will, investing in a goose that lays the golden eggs of rent. And as long as you care for it, feed it with electricity and gas, keep the feathers dry so that the roof isn't leaking, it's going to continuously produce those golden eggs of rent for you, okay? So with that, I don't know if I've got time. I do. I've got a few minutes. Any questions? Yes.
You mentioned the shift in office space from 200 square feet to 110 square feet.
Right.
From the work that we do, we're seeing a shift in the composition of medical office buildings.
And I bet you it's going up there, isn't it?
Well, the interesting thing is they're trying to get less space, but they're also trying to increase the throughput. And the next generation of medical or office space doesn't look like the old generation. So there's a
I'm not surprised.
there's a huge difference
Right.
in the quality of this, as hospitals are trying to figure out how to move as much stuff out of the hospitals into medical office buildings. So
Right.
the question I have, bottom line, is what's going to happen with the older generation of real estate, of medical office assets?
Right. And that's a very good question. If it's in a normal type office building, that means it's got tenant finish that can be torn out and the reconfiguration can happen. And one of the things that I see, I've got a son who's a vet, which is, somewhat similar, if you will. And when we looked at old designs versus new designs, you used to have, an X-ray room and a place to do wet the negatives and all that kind of stuff. Now it's on a computer and it's a little handheld thing, right? So the use of that space has changed somewhat. You're having much nicer receiving areas for your clients and things like that. So things are changing, and how you throughput obviously is something that the medical industry, I'm sure, is in the process of trying to figure out. And you're correct. Bringing out X-ray, bringing out MRI into, out of the hospital into other places really changes. I mean, it's not just a general doctor's office. It's now a specialized, facility with different things. So, and obviously at a lower cost. So from that standpoint, again, I haven't studied it, but I'm sure that's something that Revista will be, we could work on and do a kind of interesting study on that, would be what's the evolution look like and where are we going? In other words, maybe there's a way we could look at a per doctor, how much square feet per doctor, outside of a hospital, and what does the hospital have and what's now being outsourced would be a really interesting way to look at it. Other questions? Yes.
Your example of an analogy valuing real estate somewhat perceived inflated prices as it relates to the basis points over the 10-year works if the 10-year stays low.
Correct.
And your fixed debt is long-term.
Correct.
So I'm curious to know why you think the 10-year is going to stay low for a long time.
Because the world is absolutely afraid of events, and everybody is sitting on, it goes to the safe harbor, which happens to be U.S. debt, right? You have other countries that have negative interest rates on their debt. Japan is at 0 right now, and they're talking about going negative. So I'm afraid of the stock market. It looks too volatile. It's crazy. And as a matter of fact, personal opinion, I don't think the stock market's investing anymore. It's gambling, right? With all these crazy hedge fund things and computer trading and everything else, stocks used to trade on fundamentals. I don't think they do anymore. And so that is a problem where investors are, give me something else, right? And so everybody sits on a lot of, puts a lot of their money into bonds, right? And if you will, think about this, the government, it's better for the government to have low interest rates, right? Because we have such a huge debt. If interest rates go up, the percentage of the federal budget used for debt payment starts to go up. It used to be 40 to 50% back in the 80s. Today it's sub 10%, which kind of allows them to, well, this isn't costing us that much, so we can go out and borrow more, which is nuts too. But I just can't see why. And the Fed, they're definitely going to tighten by mid-year. And now they'll definitely do a one raise before the end of the year. And last time they raised, what happened to 10-year? When the Fed funds rate went up, 10-year went down, right? It's now been over 6 months that the 10-year Treasury has been sub 2%. And that's never happened in history. That's never happened in 200 years. So I think we're in for a long-term low inflation and low interest, at least for the foreseeable future, next 4 or 5 years. Okay, over here.
I saw in your charts that demand supply equilibrium was pretty good in the 90s, but it seems like now with more analytics, more data, more access to data by developers, why is that demand supply so out of balance?
Because it takes a while to build, right? Suburban office might go up in kind of a year and a half. Downtown is typically 3 to 4 years now, so things are looking good. Let's start, right? The last high-rise office building built in Boston is the Shawmut Bank Tower. It took that developer 8 years to get it done. When they started it, Fidelity was one of my big clients. I used to go in and talk to the guys at Fidelity and went, smart developer, things are looking good. It's a great time to be building an office building. As it topped out, they went, what a stupid developer, right during the bad times, et cetera, right? So it's tough. It's much tougher to build. So supply is being constrained by, let's face it, when I used to develop, I used to develop in New Hampshire up above Boston, and first section I did a residential subdivision, right? 1 permit, 1 month, I'm putting road in. Last section of the same development, 200-acre development, took 2 years and 9 permits or studies or this or that, wetlands, and I didn't have any of that the first time around. Now it's just a lot more expensive and takes a lot longer for it to happen. So the supply and demand lag is much higher today than it used to be. Yes?
Psychology of development.
Well, developers, I actually got quoted in the Wall Street Journal years ago on this, and my boss was not very happy with me. I was at Price Waterhouse at the time. I said, developers are like dogs. If you put food in front of them, they'll keep eating, right? Give me financing and I'll build it because I'm making money when I'm building. right?
Yep.
Especially if I'm
Especially
using,
if you're a fee-based builder.
right. And,
developer.
well, and it's opium, other people's money,
Yeah.
right? So give me opium, and I'll keep going.
When you were with Prudential, I was one of your partners. Thanks for the money.
So, yes.
The question is, you look at the risk profile of apartments, office, industrial, and the product type has a lot of reversion value. There's another retailer that will come in. I think healthcare has a lot more risk associated with the development side of that. We're seeing millennials that may be using telemedicine. We're seeing changes in the way healthcare is delivered. We're seeing reductions in CMS reimbursement. So can you talk a little bit to the risk
Sure.
associated with healthcare?
Sure. Well, and let me start by saying this. So as we look at the evolution of what's happened, you would think, I was actually in a conference here in Denver in 1992 where someone predicted no one would be buying in retail stores. This is the cable TV industry, and this is before the internet was, Al Gore invented the internet, right? And it basically said everyone will be buying everything online. And not true, right? We're tactile people. How retail space is being used and rented continues to change. My analyst when I was at Legg Mason doing stocks said retail is creative destruction, right? New concept comes out, it kills off something else, and then that space has to be used and it moves around. Big boxes killed off small stores, Walmart, all that kind of stuff, and it keeps coming back around because people use that space. Okay. For office space, obviously the demand per square foot for normal office computing is going down. It appears like it's going up in medical office because of bringing stuff. Hospitals are a lot more expensive than office space, right? But that office space can still be reconfigured for something else. And one of the best examples of that is in the big downturn in New York City, all the old empty office buildings got converted to apartments, okay? So there's reuse of all kinds of stuff. As a matter of fact, at the University of Denver, what was originally an office building, the university ended up taking over and it got turned into apartments, and then the University of Denver got it and turned it into student housing. So this original office space has been converted twice into other uses. So I'm not too worried about it because while we can do a fair amount, I think, with electronics, there's still the need, that face-to-face with a doctor and tests that can't be done on my iPhone, are not in the next 5 years or maybe next decade. After that, who knows where it's going to go. Okay, but think about this. We are social people, right? Revista could have sent every one of you an eyeball camera if you don't already have one, and we could have FaceTimed this entire thing. But you're here, why? Because we like to get together and connect. That's why hotel, demand is high, and millennial generation has a big preference for experiences as opposed to things, and that's one of the reasons that hotel occupancies are higher than they've ever been. Okay, I think my time is up. I'll hang out for a few minutes, but I believe that it's time for. Okay.
Thank you, Dr. Miller. That was a great start to the conference. Give him a round of applause. In your bags, when you stopped by registration, you have a final program. And on page 9 is a free coupon for a gourmet coffee. Perfect time to use that is now. Harrison Street is the sponsor of that free coffee. We have our reception coming up at 5:30. It's a bit chilly outside, so instead of doing the pavilion, we're going to be right off the lobby where the networking lounge is. That's where the fireplace and the chairs and all that's where it's going to be at 5:30. And if you're part of the VIP reception, that's starting now. All right?